Welcome back to Real Estate Mindset. Today's video is going to be absolutely bonkers. Now, the data is in, and today we're going to talk about the mortgage interest rates violent explosion and obliteration of home buying demand. And I'm going to show you guys just how bad it really is to pay a 7 or 8% interest rate. And then also, you guys, I'm going to compare what Ben Bernanke, the Federal Reserve Chairman, was saying in 2006 versus what Jerome Powell is saying in 2023. And I think you guys are going to find it absolutely shocking. It's almost as if they're copying and pasting exactly what they said back in 2006 to 2008, and they're saying the exact same things right now. I have some good finds today, and I think you guys are absolutely going to love this video. And if you can, for the effort, like the video, subscribe if you haven't already, shoot me a comment below. But either way, I really hope you guys enjoy today's video. Where I want to start, guys, is by taking a look at mortgage interest rates according to Fred. And you guys can see that this was recently updated as of August 17th. Now, this updates every week. It's going to be listed in my description if you guys want to follow along. But really what I want to point out is a couple things. Essentially, the violent surge of interest rates. About right here, October 2021, interest rates were only 3.05%. Okay, now they ran up in less than a year, okay, all the way to here, which was a 7.08% rate. So that short amount of time, you guys, and here's really the big problem. And we hear this a lot. Back in my day, rates were this high, blah, 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 blah. But again, the problem is never before in history have we had a double up in interest rates in less than a year. And what I'm trying to point out to you guys is, quite frankly, the economy and financing sector cannot handle that violent surge of interest rate. There's not enough time to adjust for a double up. When we compare right here to where we're at today, it's actually a little worse than it was last year. The difference between October here and when we're at right now is 404 basis points, which means in roughly about a year and right now, 40.4% of purchasing power has been completely obliterated from the market. What I want to do is an exercise to show you guys how much money you would actually be paying if you went to purchase an overvalued house right now and got a 7 or 8% interest rate. And I'm going to tell you guys, you really need to pay attention to the information I'm about to show you, because there's so many people, realtors, bullying us saying that we're throwing our money away renting, when the reality is, for example, I'm renting. I'm not throwing away my money renting, because as I'm renting, I'm improving myself and my purchasing power is evolving to the next level. So it's okay as long as we stay proactive. But either way, you guys, let me show you how much money you would waste. And it is a ton of money. Now, in order to do this, I'm going to get some median information, starting with the median sales price. So we're going to use $410,200 because that's the median as of June 30th. The next thing I'm going to do is go to the Consumer Financial Protection Bureau, and I'm going to show you guys the Explore interest rate form. I have this linked on every single one of my videos if ever you want to explore how much it would truly cost you to get a mortgage right now. Let me show you guys what I've done. I put a house price of $410,000, and I actually put a 20% down payment. Even though the average down payment is less than 20%, I'm still using that. Now I want to scroll down here and show you guys just how bad this really is. Now I'm comparing a 7.25% to an 8% interest rate. So just looking at the 8% interest rate, what we know is for the first 5 years of the loan, you would essentially be throwing away $128,000 in just interest. Now, the way that these loans are amortized, you pay most of the interest at the beginning of the loan. That's why 30-year fixed rate mortgages can be so bad, because you pay the interest before you pay the principal. And when we look at the 7.25% section, which is more realistic as to what's right now, you can see even at the lower interest rate at 7.25%, your 5-year cost, again, for the average home, this is the 5-year cost, is going to be $115,000. And y'all, over 30 years, look at this, $477,000. If you go buy the average house right now and you get today's interest rate, that's how much money you would be paying over 30 years of just interest fees. I want to go one step further and access this amortization schedule. This is also going to be linked in every single one of my videos, so you guys can access this yourself. But I want to show you guys just how much principal you pay off in 10 years. Okay, so again, we're starting with a purchase price or loan amount rather of $328,000. You can see that here. We have the average interest rate of 7.09%. This is a 30-year term. Total amount of interest you're going to pay, this is slightly lower interest rate, $464,000. But let me show you after 10 years what your principal amount is. So after 10 years of paying your mortgage, all you've done after 10 years is paid your loan down from $328,000 to $282,000. That represents a $40,000 reduction in principal after 10 years. Think about that for a second. After 10 years of paying your mortgage, 1/3 of the time, you only pay $40,000 in principal. Meanwhile, you would have paid over $200,000 in just interest. Let me show you guys how much money you would actually pay off if you just did $300 extra per month towards principal. It's very easy to show you guys this. All I do is put $300 here where it says extra monthly pay. I calculate it, and let me show you guys how much money is saved. You save almost 8 years for a total interest savings of $160,000. So I really want you guys to meditate on that for a second, because really all you're doing is paying $300 extra a month, yet you save $160,000. So in other words, something that we should be talking about is mortgage hacking, right? You want to be able to pay your mortgage off as fast as possible, because unfortunately, the longer it takes you to pay your mortgage, the more fees you will have. And also remember this, generally every time you refinance, unless it's into a shorter term, like a 30-year into a 15-year, you have to start the amortization schedule all the way from the beginning again. So the reality is if you refinance, it can cost you a ton more money than you might think. I want to take the median household income, and I'm going to use an affordability calculator, and I'm going to show you guys how much the average American qualifies for right now with today's high interest rates. Now, in order to do that, I have to find some median average information, starting with median household income. So as of May of 2023, the median household income was slightly less than $82,000, sitting at $81,454. I'm also going to calculate the average debt for most Americans. So starting with credit cards, the average person pays $430 per month on their credit card debt. To me, that's absolutely shocking. I pay $0, and so should you. Now, taking a look at auto payments, and we're just going to use used cars because new vehicles is much higher. The average monthly payment for a used car right now is $516 per month. And with school loans starting in less than 2 months, I'm also going to include the average school loan payment. And as you guys can see here, according to education data, the average payment is $503 per month. Now, one more thing I need is the average credit score, because the interest rate and credit score correspond. Generally, the higher your credit score, the lower the interest rate. The lower your credit score, the higher your interest rate. So as you guys can see here, the average credit score is 714 FICO score, or rather 700, because FICO scores go in tiers of 20. So basically it's a credit score of 700, 720, 740, and 760. And being that this is 714, we have to average downwards. So their qualifying FICO score is actually 700. Now, when we go to this really cool chart called the Home Affordability Calculator, again, which will be linked in every single one of my videos, we can start putting in the average information to see what normal consumers can actually qualify for. And I think you guys are going to be absolutely blown away. So let's start with the annual income, which is $81,454. Okay. Now, the average debt for credit cards, auto loans, and school loans is a whopping $1,454. And I'm going to tell you guys right now, this is the reason so many people don't qualify for a home. Right there. That type of monthly debt payment absolutely destroys your purchasing power, which is why I'm always trying to tell you guys, make sure you are out of all consumer debt. The more consumer debt you have, again, the less purchasing power. Let's say the down payment will be $40,000. That's a lot, but we're just going to say these people are well off. So $40,000. Now, the thing is, guys, this is not accurate yet because it's using a low 3.75%. So far what this says is the average person, if rates were 3.75%, could only qualify for a $196,000 house. That's half the average value of a house right now. That's insane. When we changed the interest rate, say to 7.09, look at what this changes to. Look at that, you guys. The average person right now in America, as a result of bad spending habits, credit card debt, car loans, auto loans, and high interest rates, only qualifies for a $154,000 home. This should tell us just how overvalued houses are right now. I want to make clear, when we compare what's going on right now to 2008, there are a lot of things that are different, and there are some things that are the same, and then there are some things that are worse. Now, one of the things right now that is worse than 2008 is affordability and the amount of money that consumers have going to pay their mortgage. In other words, things are more expensive right now than 2008. Now, I was in 2008. I was a loan officer and realtor starting in 2002. So I personally went through the entire cycle of the great financial collapse. And I can tell you, as being a successful loan officer in that day, it didn't matter if someone had a fixed rate. It didn't matter if someone had an adjustable rate. It didn't matter if they went full doc. It didn't matter if they stated their income. The reason why there was a total collapse was because people could no longer afford their mortgage. Why, you may ask? Well, one of the reasons why was the total collapse of real estate. So realtors and loan officers lost their job, but also don't forget, unemployment skyrocketed, which is one of the missing ingredients that we have right now. When people lose their jobs, it doesn't matter what type of loan they have. If you're out there purchasing right now, make sure not only you have a wedge or equity, but also make sure you find a primary residence that can cash flow. If you do lose your job, you can move and not have a foreclosure or short sale on credit. This chart shows us how much more expensive homeownership is right now, which is right here, compared to right here, you guys, which was the peak of the great financial collapse. This chart takes median household income basically divided by your principal and interest payment on your mortgage with 20% down payment, and it's not including taxes and insurance. So I just wanted to tell you guys, right now there is more than 36.4% of the average income going to pay the mortgage, because again, they're not counting taxes and they're not counting insurance. To me, that is reckless and not showing us just how unaffordable home ownership is right now. I want to go even further, and I want to compare what the officials were saying back in 2006 compared to what they were saying right now. And I think you guys are going to be absolutely blown away how it's almost word for word. Take a look. This is a Seattle Times article. This is dated December 12th, 2006. Almost exactly the narrative we have right now. Call him a brilliant economist or just lucky. But Federal Reserve Chairman Ben Bernanke appears to be guiding the economy to a soft landing. You guys, when we see wordage like this, to me, that is a massive red flag, and that's exactly what we see right now. And if I may, one more article from the past. This is from ABC News. Let me read this for you guys. Again, this is back in the past, right before the great financial collapse. Markets have the shakes. The housing sector is searching for a bottom. Consumers look frightened. Oil prices are volatile. Is an economic soft landing supposed to fill this rough? The Federal Reserve meets today to discuss interest rates, bolstered by data pointing to the slower, sustainable growth and gradual moderating inflation it has predicted. But Fed Chairman Ben Bernanke and his colleagues also face turmoil in stock and bond markets despite Monday's stock rally, as traders worry that an economic expansion built largely on easy credit is too brittle to hold together. Wow. Kind of like right now, right? With COVID and lockdowns and stimulus and PPP and EIDL and the nearly 50% run up in equity in 2 years. If you ask me, it's too brittle. It goes on. In the near term, Fed officials have given no hint of budging from their current policy of keeping interest rates steady as they focus on tamping down inflation. The central bank held a key short-term rate at 5.25%. from more than a year. And if I may ask you guys, what's the federal funds rate right now? Interesting. Well, you guys can see here from bankrate.com, the federal funds rate is actually the same exact interest rate at 5.25% as it was right before the great financial crisis.
When Ben Bernanke was sworn in as Federal Reserve Chairman in February of 2006, Housing prices had already begun to spiral downward. Just a few weeks later, Bernanke presided over his first policy meeting at the Fed and said he believed the economy would pull off a soft landing. From his perspective, falling home prices were not a huge concern.
And at that meeting, he talked about that he thought that housing had peaked and was starting to decline, but he thought it could be, any damage could be contained.
That mindset prevailed for the better part of the next year.
Whoops.
It wasn't until after the demise of Bear Stearns that the Fed saw the housing crisis was far worse than it realized.
Even going into 2008, that they recognized the severity of it. And it wasn't until the fall of 2008, after Lehman Brothers collapsed and the financial system basically froze up for a time, that the Fed really saw they had a major problem.
And of course, the problem continues to this day, with the Fed keeping interest rates at record lows.
The staff said the possibility that the economy would enter a recession sometime over the next year is almost as likely as their baseline forecast. Is that where how you look at it?
So I have resisted the temptation to handicap it.
Go on.
I think I'll continue to do that. But I get the way I think about it is I do continue to believe that there's a path to a soft or softish landing. I do believe that, and
the definition of a softish landing is what?
Soft.
Unemployment goes up a little, but we don't have a recession.
Yeah, unemployment goes up, but it's not a hard landing. It's not a severe recession. You can think of unemployment going up, but not really spiking as it does in some recessions. So that's how I think about it. And I think the path is pretty clear. The labor market conditions soften. We see inflation, and the goods inflation gets better. Housing services inflation gets better, and the labor market softens but doesn't go into recession. And you see inflation start to come down. And I think that's very plausible. I don't want to be the handicapper on it. And, of course, our job is to try to achieve that. Mm-hmm. And I think it's still achievable. Although, if you look at the history, it's not a likely outcome. But I would just say this is a different set of circumstances.
Do me a favor, comment below. Let me know what you guys think about our officials, the fact that they're saying similar things as the past. Do y'all think that we're really going to avoid a recession? Do you guys think that home values are going to be fine? We've already seen them decline. There is no mistake. In pretty much any value calculation algorithm, values have already spiraled downward. Now, there's been a rebound. I think the rebound is more of a dead cat bounce, just like 2006. Almost identical, actually. Now, what do we do with this information? And I'll say this, you guys, I understand there's people purchasing for different reasons. I believe the longer we wait, the better deals that we will find. But I do want to say this, regardless of when you buy, okay, whether you're trying to time the bottom of the market or not, and I'm not trying to time the bottom of the market. I'm trying to find a great deal. And remember, to me, what a great deal is number one, finding a primary residence that you love. Number two, having a realistic expectation, the fact that you may have to hold the property before you can do anything for 10 years. Number three, you want to comfortably afford the house. And number four, probably the most important thing of all, when it comes to purchasing our primary residence, treat the purchasing process like it's an investment property. Find a primary residence that has wedge or that's purchased for undervalue. Because when you purchase property for undervalue, you walk into a house with equity. And if home prices go down, like I believe they're going to go down, the more equity you start with, the more that home prices can go down before you get upside down in the house. Do y'all understand that? I hope you do. And the cash flow is if you ever have to move, maybe you lose your job, you can't sell your house because you're upside down in equity, the cash flow will allow you hopefully to rent out the property and not have to go into foreclosure. Some of the lessons that I wish that I would have learned when I had my own personal foreclosure back in 2009. Now, other than that, guys, I really hope you enjoyed this video. Happy Saturday, and I hope you guys got some new insights, value, and perspective. And if you're out there investing in real estate, I wish you luck, and I hope you win.